Welcome to Uncommon Sense, where ordinary financial wisdom just doesn't cut it. Follow along with Erik Bowman as he provides clarity in a cluttered financial world.
Hi, everybody, and welcome to the Uncommon Sense podcast. My name is Erik Bowman, retirement income certified professional, certified tax specialist, and certificate holder of the National Social Security Association. With me on the podcast today is Ben George. He's going to help keep us on track as well as help with production here. Ben, how are you doing today?
I'm doing well, Erik. Looking forward to being on the show with you. And I know we got a good topic to start things off.
We sure do. Today, we're going to be talking about inherited IRAs, the taxability and timeline for making distributions if you're lucky enough to inherit an IRA. There have been recent rule changes that the IRS put down just in the last couple of weeks. And so we're going to cover those. They're extremely important to understand if you are the beneficiary of an inherited IRA.
You know, there's always changes with the IRS, right? That are hard for the normal person to keep up. We got life going on. We got kids, family. It's hard to keep up with all the changes. And this is something that even goes back a couple of years too, right?
Yeah. I mean, the law was changed years ago, but it was too vague when they created the law changing inherited IRAs. And so maybe a little bit of history is if you go back to 2019, for example, an inherited IRA, when a non-spouse received an inherited IRA, what does that even mean? It means that maybe dad left an IRA to a child. So that is now an inherited IRA. The deceased father's name will forever be listed on that IRA. And of course, the child, the new owner, will also be listed on that. And they used to have distribution rules that were based on the longevity or lifespan of the child in this example, the person receiving it. And it was commonly called a stretch IRA, which meant they could stretch those distributions out over their entire lifetime. One of the primary benefits of that is spreading taxation out, because every dollar that comes out of an IRA or an inherited IRA is fully taxed at ordinary income tax rates.
Okay, that makes sense. So that changed. So that was a great benefit, but now they've condensed that down, right?
They've condensed it down. So we're talking right now, there's two potential beneficiary types for an inherited IRA. There's a spouse, and there's a set of rules when the spouse inherits an IRA, and then there is a non-spouse. So most common is a child. So somebody passes away, a mom or a dad, and they leave their IRA to their child. It becomes an inherited IRA or a beneficiary IRA. The rule change is this. The IRS came out years ago and said, if you are a non-spouse and you receive an IRA and you now are the owner of an inherited IRA, you must distribute that inherited IRA within 10 years, meaning by the end of the 10th year, that account must have a zero balance. So they compress that timeline significantly. And one of the outcomes of compressing that timeline is more money has to come out faster. And if that ordinary income, taxable income, is on top of maybe the child is married in their 50s and they have really good income, now they have additional income on top of their household income, and it could push them into higher tax brackets. And I unfortunately or fortunately, I believe that's what the government intended. They want to get their tax money faster, and they would prefer it being paid out at higher tax rates. So that is kind of how it was left back in 2020. And then there was a lot of ambiguity. Well, do I have to take a little bit out every year? Can I wait until the last day of the 10th year and take it all out? That was the question that was left behind that really needed some answers.
Okay, we're about to provide you some answers. I'll remind you too, if you haven't been in contact with Erik before or want to set up a time to meet with him, you can find everything at bowmanfinancialstrategies.com. You can also schedule a complimentary consultation online there. And I'm sure a lot of people probably have questions. At Inherit IRA, it's a great place to start. So we talk about taxation. What changed then, Erik, then when they provided a little bit more clarity, hopefully a little more guidance? What are the rules now? What do you have to know if you do inherit an IRA?
Yeah, great question. So the change is that indeed, if the deceased, so in this case, the father, was already drawing required minimum distributions, then the recipient or the child who gets the inherited IRA must use a calculation provided by the federal government to determine how much they're going to take out every single year. It'll be basically a percentage of the account balance on December 31st of the previous year, which if we read that, the alternative would appear to be the case, which is if the deceased was not taking required minimum distributions, then the recipient does not necessarily have to take out annual distributions, and they could theoretically wait until the last day of the 10th year and then do a full distribution of the entire taxable amount. So this information actually came out in the Wall Street Journal. The law didn't specify. I'm going to quote from the Wall Street Journal, July 19th, 2024. The law didn't specify whether people had to take out money each year or could wait until the final year. So the investors were asking the IRS, we need some clarity, and it did take them years to get that done. And the rule affects mostly heirs, beneficiaries, or children in this example. So it's complicated. It's not obvious how much you have to take out, when, or over the 10-year period. It's just a complex thing that most people are going to need to rely on an accountant for, which that's actually a really good takeaway. You need to work with your financial professional or an accountant when you are determining what you're going to take out, because if you fail to take out some type of required minimum distribution, the penalty can be as high as 25% of the amount you were supposed to take out. So a lot of incentive to get this thing right.
So just to be clear, the biggest, I guess, thing to pay attention to, just the black and white of it, is if the person that is deceased was already responsible for RMDs, then it just picks right up. But if not, then you have a little bit more, I guess, leeway.
That's what it sounds like from the letter ruling that they came out with. It seems to allow for flexibility. You know, if a parent dies young, like at 55 years old, and a child receives it, that 10-year rule applies. However, it doesn't appear that there's a mandated annual distribution if the deceased was taking required minimum distributions, meaning they were 70 and a half or 72 or 73, depending on when they were born, then they would have the recipient would have to start taking out distributions on an annual basis.
Okay, and this is the non-spousal. The spousal, is there anything tax-wise that you need to know there, or is anything changed on that front?
Yeah, that's another really good observation. So a spousal, generally speaking, when a surviving spouse receives an IRA from the deceased spouse, the deceased name does not appear on the new account. The IRA simply becomes the IRA of the survivor. So let's say husband passes away, leaves $1 million IRA to a surviving spouse. That surviving spouse now simply has an IRA in their name with worth $1 million, and they can invest it how they'd like to. And the required minimum distribution calculations in the future will simply be based on the basic rules that apply to that individual, the surviving spouse. Meaning, if their date of birth is such that their required minimum distribution year is age 73, well, then that full $1 million doesn't begin any RMD calculations until the survivor achieves age 73. There are some odd exceptions if there is a difference in age of over 10 years, and if the recipient was receiving required minimum distributions, there can be some other complex rules that apply. You'll want to get with your accountant on that one. But suffice to say, and generally speaking, and in my experience, the deceased IRA becomes the surviving spouse's IRA.
Social Security planning can be complex, but you don't have to navigate it alone. Visit our one-stop Social Security resource at bowmanfinancialstrategies.com. Discover detailed videos, downloadable PDF guides, and the latest updates from the Social Security Administration. Don't let Social Security questions hold you back. Click the link in the show description and bring Social Security into focus.
The rules then, I guess, with the taxes, first thing is you need to get help, as you pointed out. If you inherit an IRA, first step is to sit down with someone and start thinking about different strategies, the best plan of attack for taking that money out. But what are some ways that maybe someone could prevent some of this taxation, or at least lower what you might owe on this inherited IRA?
Well, let's say you're a child and you receive it and you fall under the category that does not have to take out an annual amount. Depending on your age and when you plan to retire, you may not make distributions until you retire, so you're not stacking income on top of income, pushing you into higher marginal tax brackets. You might wait until that first year of retirement and then start making distributions to potentially supplement Social Security, pensions, and other income streams. but because it would be taken out on basically a clean slate, you're no longer earning W-2 income, you can structure your distributions from all of your various sources in a way that you can pay less taxes than somebody in a similar situation who doesn't actually do the calculation. So that flexibility is really important. I wouldn't just make automatic distributions if you don't have to while you're still working, if indeed it's going to put you in a higher tax bracket.
Yeah, absolutely. Again, have those conversations if you want to with Erik. Again, bowmanfinancialstrategies.com or 303-222-8034. We'll throw all the contact information in the show description as well. What about for someone that knows they're going to pass along an IRA potentially? Is there anything they can be doing right now to maybe prevent some of this taxation from happening on whoever benefits?
Now you're hitting on something we call planning, things that we do before the event, right? I've heard many times from people who say, oh, my existing advisor said he didn't bother addressing, inherited IRAs or Social Security planning because I'm not retired yet. Well, in my opinion, planning insinuates activities you do prior to the event. So you're planning ahead of time, not waiting for the event to occur. So to your question, the answer is very specific. There are a few different options you might have. The most obvious to me is doing Roth conversions. So if you are alive and you plan on leaving a significant IRA money to children, by doing Roth conversions, paying the taxes once and done in the year of conversion, moving it over into a Roth IRA, all future taxation is zero. There is no tax on distributions from a Roth IRA, nor on the growth of a Roth IRA. So by moving it in there and paying the taxes early, when your child receives a Roth IRA, they have no taxability on the distributions. Interestingly, the government still mandates a 10-year distribution timeline, but they don't collect any taxes on those distributions.
That's interesting. It seems like if there's no taxes, what does it matter if it's 10 years or 30 years?
Great follow-up. So this is subjective, right? Who knows what's in the mind of politicians? I could come up with a reason, and one of those would be by forcing them to take money out over a 10-year timeline, then that younger person that receives it can't just let it grow tax-free forever and then pass it on to the next generation and the next generation. The government wants that money to get socialized back into the economy or back into accounts that are taxable. So for example, if you make your distribution from your Roth IRA that you inherited over that 10-year period, there could be a likelihood that, number one, you're going to spend it. So that money goes into the economy. All sorts of taxes apply to all expenditures in the economy. It could go into a non-retirement brokerage account. So if it goes into a non-retirement brokerage account and is invested successfully, then it's going to be taxed at capital gains rates, and also the interest and dividends from that account are going to be taxed as well. So the quicker the government gets the money out of the Roth, the faster that money starts to generate taxes for the government. And I believe that's probably why they have that 10-year rule even on a Roth.
Okay. Probably going a little off track, but it just gets me thinking when you talk about these things. But could you not just take that money out of a Roth and then move it into another Roth?
You cannot do that. You have to actually make a distribution. So that's a formal term. And then depending on your income, whether you have a qualified plan at work, it's actually way more complex than people think. Whether or not you can put any money into a Roth is dependent on a lot of those different factors. So it is not a straight line that you could take that money and put it in. You're subject also to contribution limits, among other things. So it's not as easy as that, unfortunately. Very common question, though. People say, can I just move it into this other Roth? And the answer is no.
Okay. Makes sense. So they got to get that money out there somehow. That all works out. All right. So again, if you have any kind of questions, if you want to start planning for your IRA that you have now that you might pass along, or you inherit an IRA and you're trying to figure out the best plan for distributing that money, sit down with a financial professional like Erik at Bowman Financial Strategies. And Erik, I guess this is probably a pretty common way somebody comes to find you, right? Is I inherit some money. I've never done a whole lot of planning before, but I know I need to do something with this. So it's a great place to start that conversation with an advisor.
It happens quite often. You're exactly right. If people don't have significant liquid assets, they don't have a lot of investment experience, and then they come into meaningful assets from a parent, Many times they don't feel equipped to make the best decisions on how that money should be allocated for their stage in life. So that's obviously an area of specialty of ours, is not only determining what's an appropriate allocation of assets between different tools to help them reach their goals, but then in retirement, when it is time to make those distributions, providing clarity on when and why and how much you should take out of these different accounts, always keeping an eye on tax efficiency.
All right. Well, I got a much better understanding today after hearing you kind of break this down for us. And hopefully everyone listening, watching the video right now will have the same kind of, okay, I feel a little bit better about what's going to happen, what I need to do with this money, what I'm required to do by the IRS, because we don't want to get penalized any more than we are. So very good to know that information. Anything else to kind of wrap this up with, or do you think we hit on what most people need to know?
I think we've probably hit on most of the strategies and high-level observations that you should be aware of. Just make sure you seek professional help. I think that's the number one takeaway here, because it is complex.
Awesome. Again, that number 303-222-8034. Appreciate it, Erik. Thanks for the breakdown today on the inherited IRA, and hopefully we'll get some questions from this.
Yeah, Ben, thanks for joining me today. I appreciate your assistance on the podcast, and you have a great day.